Some of the richest people in the world are from funds. If you look at any sort of top 500 list, whatever you look at, you're going to see most of them are going to be fund managers. Some of the richest people in the world are fund managers. Welcome to Funds on Fire, the podcast that ignites the passion of investment funds and capital raising. Here we turn the complexities of fund management into clear, actionable steps that drive results. I've invested into diverse real estate across the United States and managed thriving funds, and I'm committed to transforming lives through the vehicle of investment funds and helping others to do the same. Join me as we document the journey of scaling businesses, raising capital, and impacting tens of thousands of people around the world. My name is Devin Robinson, and welcome to Funds on Fire. I'm excited to kick these off because I love funds. I will spend the rest of my life diving into funds, and I think there's so many amazing ways that fund can take a really interesting role in being able to scale opportunity and be able to scale impact that you can have into the world, and that's the main reason why I love it. Yes, of course, some of the richest people in the world are from funds. If you look at any sort of top 500 list, whatever you look at, you're going to see most of them are going to be fund managers. Some of the richest people in the world are fund managers. I actually saw a statistic that said out of all the billionaires in the world, which there's 2,700 of them, 15% of them are some sort of fund manager, and another 15% are real estate. So for what I do, 30% of the billionaires in the world operate in the realm in which I operate in. It's just a really unique opportunity to be able to scale impact in the world, especially if I want to change the world. And so very excited about talking about this, and we're going to dive into all different types of stuff. Today, I want to share a little bit of our personal journey of funds and explain what investment funds are, how they differ from syndications and joint ventures, and give you an overview of the major type of funds. We're not gonna dive into a lot of super specifics. I'm gonna save that for a little bit later, and we're gonna have specific episodes for like fee structures and each type of fund and some of the securities laws and what that entails and how you can raise capital. We're gonna dive into all of that on this. But today we're also gonna touch a little bit on securities and what constitutes a securities to help you to stay compliant and safe if you're trying to get private lenders or whatever, so that you know that you're not operating within a securities. So for us, we started our fund because we needed capital. We were operating in a single family space, and we had a lot of people that were going through foreclosure, and so we were in need of capital. And so we decided that we were going to start a fund, go ahead and pay all of the fees that are necessary. And when you start a fund, typically what happens is you have to go to an SEC attorney, and SEC is going to make different documents. So when you start a fund, you're going to need an SEC attorney, and that SEC attorney is going to put together something called a PPM, which is your private placement memorandum. It's like 100+ pages of regulations, what the thesis of the fund is, the management, all of those things, your partners, all those things. And then you're also going to have a operating agreement, and then you also are going to have a subscription agreement. So these are the kind of documents that an SEC attorney is going to put together for you to make sure that you are compliant with SEC laws and stays within the securities. Now, these kind of documents are going to cost you anywhere between $15,000 to $50,000, depending on how complex the structure of the fund is and what it's going to be operating in, and depending on how good and how fast your attorney is. So these can be really expensive. And so a lot of people get sticker shock when they're like, oh my gosh, I don't know if I want to do that. Now, we use what's called customizable fund with Avestor. So Avestor, and if you're interested, you can check the link below, but we use Avestor, and they are a customizable fund. And so we'll talk a little bit more about what a customizable fund is, but it's very similar to a SPV, which is a special purpose vehicle, or a fund of funds. So you have the fund of funds model, and we'll talk about that. So I know this sounds a little bit crazy, but I'm excited to dive into it and to dive into what this is. Now let's talk about what a fund even is. So a fund is very simple. So like if you got this pool of money here, right? And you've got your investors, they're going to put in a pool of money over here. And then you've got us, which is our GP. So typically that's like the GP, which is the general partners. And then the LPs, which is your investors. That is, so they call this like a limited partnership. That's what the pool of money is often referred to as the limited partnership here. Essentially, the fund is a pool of money collected from multiple investors, pulled together, and then invested into various assets such as stocks, bonds, real estate, securities. The goal of this is to achieve diversification and benefit from professional management with its GPs offer, and gain access to a broader range of investment opportunities than some other individuals might be able to alone. And so the LPs, who maybe are savvy investors, and we'll talk about what the SEC, how they characterize these investors from non-accredited accredited investors to accredited investors to qualified clients and qualified purchasers. What the SEC is the Securities and Exchange Commission, and it was created to protect investors who don't know a lot, because a lot of people were getting scammed, and so they came out with Securities Act of 1934, which helped to protect people who weren't really savvy for investing from people who were scamming a lot of people. And so they created this, and then they categorized these different people. And so what ends up happening is they pull the money together here. Then what happens is this pool creates a return. This return is sent back into the pool, which is sent to the LPs and then sent back over to the GPs. So that's how a fund works. And so there's different types of fee structures, which we're not going to dive into fee structures today, but you'll hear all different types of fee structures that we'll talk about. We'll talk about 2 and 20s. And then there's also, you have American waterfalls, European waterfalls when it comes to structuring this. And you can get really, really creative to create insane returns for your investors as well as for yourself, which is really good. Now, the basic structure of funds also, so we talked about, we've got the investors, we've got the fund managers, and we've got returns. And the returns are the profits from investments that are shared between the fund managers and the investors. Now I want to talk about the differences between joint ventures. So a lot of us has heard of JVing, right? You've got joint ventures, syndications, and funds. Okay, JVing is more of a business arrangement where 2 or more parties agree to pool their resources, not just money, resources for a specific task or project. So the key features to this is each person maintains control of its own resources. So let's say I'm gonna come and I'm gonna say, hey, I've got this deal, right? Devin's got the deal. Mark's got the money. Right, and then we've got Michael, Mike, who will manage the project, right? So this is very similar. So we'll see this come up multiple times, but this is just going to be something where they're like, okay, we could bring this together. We're going to work together. We're going to create, mostly we're going to probably create some sort of LLC where we each have some sort of equal ownership of this LLC. And then we've got specific roles and responsibilities as we go forward in this LLC. And if I do my role and you do your role, then everybody's good. That's kind of what a joint venture is. And then you've got syndications here. So syndications, this is a little bit more based on a group of investors pulling their money to invest in a single asset. So this is more asset based, and you're gonna have a couple of people here when it comes to this. You're gonna have a sponsor who is sponsoring the deal, and then you're gonna have an investor who is investing into the deal. The sponsor is usually going to be the operator / manager of the deal, and then the investor is going to bring the money. The investor is going to be a little bit more passive in this case. They're going to be playing the passive role, and they're going to be just sending the money in while the sponsor is going to be doing the majority of the work. And that's how that's going to be run. And that's typically based on a single asset. You typically will have some sort of PPM put together for this. So this is going to cost a little bit to put together, but there could be more than one investor. This could be investors, and there could be, I don't know how many investors, but they play a little bit more of a passive role. And then you've got the funds. So the fund is typically 3 types of roles that are really talked about the most. You've got a deal finder, because a fund is going to be run as a business. It's probably not going to be just like a one single project base. It might revolve around a single asset class, but it's going to have multiple projects, multiple things that are happening. And so you're going to have a deal finder that is continually finding deals. You're going to have a capital raiser who's continually raising capital. And then you're going to have a fund manager who is continually making sure that everything is compliant and organized. The deal finder is going to make sure that they manage and operate the deals at a high level as they find them. Fund manager might also help that. Capital raiser does exactly what they say. They just raise money, baby. Okay, so they're raising all of the money.
I want to take a quick second to talk to you guys about something that could completely change the game for you if you're serious about launching and scaling an investment fund. If you've ever wanted to start a real estate fund, private equity fund, or syndication, but didn't know where to start, this is for you. Fund Founders is giving you free access to Foundations 101, a step-by-step course designed to help you to structure your fund the right way so you stay SEC compliant, raise capital like a pro even if you don't have a network yet, scale your fund without constantly chasing investors, and avoid costly legal mistakes that could shut you down. This is the exact roadmap successful fund managers use to launch, manage, and raise capital for their funds without wasting time or money. And the best part, it's completely free. Go to fundsonfire.com/founders or click the links in the notes to get instant access to the Fund Foundations 101 course. Don't miss this if you're serious about raising capital and growing your fund. This is where you start. Again, that's fundsonfire.com/founders or click the link in the notes. Now let's get back to the show.
Now, the fund manager is typically managed by professional managers. It's a group of people operating at a higher level to create that diversification and professional oversight compared to more of a joint venture or a syndication. So this is going to be actually a business. Like, this is going to be a business, and you're going to be operating in the hundreds of millions. It could be as small as, like, my first fund, where 2 to 15 million, but then it can also be as big as something like BlackRock, Blackstone, or you get into Bridgewater Capital, which is Ray Dalio's group, who operates in the billions. They don't take anybody with less than a $4 billion net worth because they only have space for 1,999 investors. And we'll talk about that. We'll talk about the different types of funds as well as the different structures for funds. So you could have Reg Ds, you could have Reg CFs. And so you have Reg D, Reg CF, which is more of a crowdfunding source. But then when you have Regs Ds, you have like 506Bs and 506Cs, which means you can have a certain amount of non-accredited investors or accredited investors. And you can market or you can't market. So there's a lot more regulation here, but then there's also a lot more advantages of filing as a Reg D. But then if you have a Reg CF, then that's a more crowdfunding. You can have people with check sizes as little as $100, $500, $1,000, depending on what your docs say. This typically is going to be a lot more work and more expensive, but it allows you to have a broader audience. So let's talk about the four major type of funds. The four major type of funds, and you've probably heard of these, are going to be hedge funds. You've got private equity funds, real estate funds, and then you've got VC funds, venture capital funds. Now, it's not limited to this because you also have like debt funds and you have fund of funds, which we could talk about later. But let's talk about the major four types of funds. This first one, hedge funds here. Hedge funds are going to focus mostly on public securities. Public securities like stocks, bonds, commodities, other types of currencies, cryptocurrencies, Forex. You're going to find all of that in hedge funds. So these are going to be funds pulled together. They're going to grab money, pulled together because they've got some sort of trading thesis on public companies, on publicly traded companies, currencies, and they're going to try to pull money together to make bigger investments for their investors. So this can vary from high frequency trading to long-term holding strategies, day trading. They use leverage and short selling techniques to maximize return. Then you've got private equity funds. These invest into private companies, right? So they're buying private companies, and a lot of times they're going to buy them, restructure them, eventually sell companies at a profit. For instance, a private equity firm might purchase multiple local businesses and consolidate them. So for instance, if you go and you see that a car wash is worth $2 million for a car wash, 5 or 6 car washes is going to be worth about $10 million, but you may take and you may bundle together 15 car washes, and that you could sell for 150 to 200 million, because now you're working in economies of scale. You're working with the ability to be able to take your set SOPs and broaden them out and then be able to package that together to create a much more valuable product. And then you've got real estate. I run real estate funds, and this invests into a real estate property. It purchases, manages, sells real estate, ranging from flipping houses to owning and operating large apartment complexes to land development. The great thing about real estate funds is you're going to be able to, a lot of times your investors are going to be able to claim depreciation off of your fund because you're holding hard assets. Now, this is going to be a more illiquid than a hedge fund. And so a lot of times we say, hey, we'll give you your money back, but you need to give us 3 months. It's called a redemption period, so that we could liquidate some of our assets to be able to get you that money back. But the perks here is they get to claim depreciation on their taxes. They also, if it's an equity type of real estate fund like ours is, then they also get to participate in profit shares from the wholesales we do, the flips we do, the new builds, all of those. Depending on how the fund is structured, there's so many benefits to a real estate fund. Now, a venture capital fund, you're going to see these invest a lot in startups, early stage companies. These provide a ton of capital up front, and they get in on seed rounds, really early investments into these companies that then end up 10xing or even 100xing their return depending on the company. Now, you're going to see a lot of these companies are going to end up in crashing and burning, but a lot of them are also going to 10x or 100x. And so that's really what VC companies are banking on, is finding those gold mines that are going to 10x their money and then sometimes even 100x depending on the type of company that they invest in. And so the main strategy here is to provide capital to new businesses with high growth potential. They aim to sell their stakes at really high profit once the company grows, and then they end up selling it. I know that's a lot of information. I want to dive into one more thing because this is really important. A lot of people ask me, well, if I'm raising capital for a real estate deal, can I bring in 3 or 4 people, maybe 5 or 6 people to be able to invest into this so I can bring their money together and that equals the price that I need to invest into that property? And typically I will say, no, don't do that. Don't do that. You don't want to bring in more than 2 people to help with do that, because then you start operating really dangerously into securities law, because there's almost no way that all of those people you bring in can be active in the deal with you. And then you start operating, if they're just solely passive, you're starting to operate as a securities. And then you might want to go ahead and go back and set up either a syndication. And you will see this a lot. A lot of people have single syndications for little houses or asset classes, different things like that. You might want to set one of those up so that you stay compliant with the SEC. The purpose of securities laws is designed to protect investors by ensuring transparency, fairness, and integrity in the financial markets. And we talked about this. This came about in 1933, 1934 in the Securities Exchange Act, when a lot of these kind of not so savvy investors were getting scammed over. And so they came together, they formed the SEC, the Securities and Exchange Commission. And this is the primary regulatory body overseeing securities laws in the United States. And so we want to make sure that if you are thinking about raising capital for a deal, if you are thinking about investing in a deal, that you are not operating as a security. A security essentially is a financial instrument that holds some type of monetary value. It can represent ownership in a corporation like stocks. It could be a creditor relationship with a governmental body or a corporation like bonds, or the rights of ownership as represented like an option, right? Like a stock option. So for example, stocks, options, mutual funds, investment contracts, all of these are securities defined by the SEC. So you want to make sure that as you guys are seeking these private investors, as you guys are investing into these different assets, you are making sure that you are really compliant and not pulling together without having some sort of legal compliance in order. So I just wanted to kind of leave that. I also want to leave a disclaimer. This is not any sort of solicitation for securities. I am not trying to pitch my fund or anything. This is just for educational purposes. I want to make sure that you guys know how awesome funds are, what they are, and then a little bit of why we dove into them. And so I hope that this episode has been really helpful for you. We will dive into what are accredited investors, non-accredited investors, what are the different types of funds, what are the different types of fee structures. I'm actually really excited to also dive into some of the biggest funds in the world, how they operate, the background behind them, some of the biggest fund managers in the world, how they got to where they are. We're going to talk about so many things on Fund Fridays. It may move into not being just Fun Fridays anymore, and I'm excited about it. So I thank you for being here. I appreciate you. If you have any questions, let me know. Make sure that you guys like, subscribe, follow, whatever, all of those things, so that you can get a little bit more information, because I will be continually giving you more information on funds in the future. Thank you so much. I hope you have a fantastic day. Peace. Wow. I hope you enjoyed that. I have a quick favor. If you've been enjoying the show, there's one simple way you can support us, and it's by hitting that follow button or that subscribe button on the app you're listening to. I want to level this podcast up in every single way possible, bringing you more value, incredible content and guests, and new strategies. Following the show and leaving a quick review goes a really long way in helping us to grow and continue to deliver top-tier content. It's the only free thing I'll ever ask you to do, and it makes a bigger impact than I can possibly put into words. So thank you for being a part of this journey, and I'll definitely catch you on the next episode. To great success and greater impact. Peace.